because we're just running out of silver. And if you look at their stockpiles on the Shanghai Gold Exchange, I mean, we're at rock bottom right now. There's almost nothing left. So if they wanted to, they could do it, just not out of spite so much as, to save their own skins, because, they have only a certain finite amount of silver they make, and they've been net exporters for many, many years. And, they can only keep that up for so long before they run into this rapacious demand for silver. Right now, there is no froth in the market. Zero. None. There's very little speculative long buying in the market right now. Like I said, the total open interest in silver and gold are the lowest they've been going back for at least 10 years in gold, and about 12 or 13 or 14 in silver. There's just nothing in the market. It's very quiet. Okay? And what happened back then was raising these margin requirements, and I used to get into a tizzy about this when they did it. And Ted would smack me across the side of the head and say, look, these increase in margin calls they put out there, which are, pretty hefty. I mean, let's face it, they were, and we got 2 or 3 in as many days. So they were really piling on the margin calls, or the margin increases at the CME. But what Ted told me is this. He says, look, if you're a small trader with 1, 2, 3, 5, 10, 15, 20 contracts, and you have a limited amount of capital behind that, then you might be in a position where you're going to be forced to sell. But if you're a big trader, one of the big 8 or even 10 or 15 traders or 20 traders out there, or maybe even the big 100 traders, an increase in margin call is just a cost of doing business. Okay, and he says, trust me, Ted was trading commodities, silver in particular, for 25 years. And he says, you're a big boy. It makes no difference at all. So, everybody jumps up and down and hoots and pants about this increase in margin call, which is, the CME group is very responsible for them to do when prices are taking off to the moon like this. That's what they're supposed to do. But for the vast majority of traders out there, the ones that are well capitalized, like I said, it's just a cost of doing business.
When prices surge quickly, exchanges sometimes increase margin requirements to manage risk. This happened several times during past rallies in silver and gold. Smaller traders often panic when margin levels rise because they may lack the capital to support their positions. However, large institutional traders view margin increases differently. For them, it is simply another operational cost of trading in volatile markets. While headlines often dramatize margin hikes as a signal of trouble, experienced commodity traders know these adjustments are routine safeguards implemented by exchanges during periods of rapid price movement.
Let me just take the title of what I said, the collusive commercial traders. Okay, in gold, that's all 49 of them. Okay, and in silver, it's only 8. Okay, because the other traders in the commercial category in silver are all long. Now, Ted had a wonderful explanation for this. Well, people ask me, well, how do you know it's the collusive commercial traders, and how do you know they're all working as a group? And Ted had a wonderful answer. He says, let me put it to you this way. Everybody in the other reportables category, the managed money traders, the small traders who are a mega net long gold, mega net long silver, and mega net long all the precious metals, they did not have a Zoom call the day after the markets closed on Tuesday to figure out how they could lose tens of billions of dollars in profits the next day. Okay. So it wasn't the guys, that were net long plotting to figure out how they could lose tens of billions. It was the commercial traders coming in doing what they normally do, spoofing, bid pulling, every dirty trick in the book, especially working in the Globex trading session overseas where there's so little volume. Then it's easy for them to push prices around, and volumes yesterday and earlier this week have been very light. So they had no trouble at all, and they can get away with this. But of course, there are laws against this. But when in these days have laws ever mattered? I mean, they were all convicted and fined oodles of dollars, and J.P. Morgan got fined almost $1 billion. And J.P. Morgan's now on the long side, And the thing is that even though it's illegal and they've been fined for it, they don't care. They can just continue doing what they're doing. So until they're smacked into place, they're going to continue doing this. But like I said, they're going to run out of road, because the problem is that the physical market's going to come in and bite them on the ass pretty soon.
In precious metals trading, a small group of powerful commercial traders can hold enormous influence over price movements. In gold markets, dozens of institutions participate, but in silver, the number is far smaller. Critics argue that these players often coordinate strategies, intentionally or not, when trading large volumes of contracts. Meanwhile, hedge funds and retail traders tend to hold bullish positions across multiple metals. When prices suddenly drop after strong gains, some analysts suspect aggressive selling or high-frequency trading tactics may be responsible. Although regulators have occasionally fined major banks for misconduct, debates about market fairness continue.
Well, where do you start on this? Let's go back to LBMA, and was it December or November? They run into a problem where they were supposed to have X number of ounces, and it all of a sudden became not available. And so they had to fly in like oodles of tons of silver from the U.S. and Switzerland and China and all these places. And so they didn't have to declare force majeure. But the giant sucking sound that you hear every day when you get up in the morning is the sound of silver disappearing out of all of the ETFs and mutual funds. It started in October, it increased in November, it increased in December. It has not stopped in January. I put these numbers are in my column every single day. In January, just to give you an idea, in all of January, the COMEX received 8.443 million ounces of silver, but shipped out 51 million. Okay, and in February, they received only 3 million ounces in all the depositories, and there's about 8 or 9 of them. And they shipped out another 51 million ounces. So in 2 months, okay, after the squeeze is over in the LBMA, the COMEX has parted with 102 million ounces of silver. That's a lot. And let me just go to gold for a second. In January, they only received 80,000 ounces at the COMEX, but shipped out 858,000 ounces of it. And it's even worse in February. They received 152,000 ounces, but shipped out 2.6 million ounces of the stuff. So the sucking sound is not confined just to silver. In the COMEX, it's gold as well. And if we want to go overseas to the Shanghai Gold Exchange and the Shanghai Futures Exchange, I've got the data for tomorrow's column right in front of me right now. The Shanghai Gold Exchange and the Shanghai Futures Exchange both, shipped out metal during the last week, quite a bit of it. And my comment here is that combined, the Shanghai Gold Exchange and Shanghai Futures silver inventories are back to what they were in October of 2015, which is ultra low compared to what they held in the past. They're scraping the bottom of the barrel. They're almost out, okay? And how much silver is left on the COMEX that they can ship out that is, because they can only ship out silver that the owners are prepared to send out. Sooner or later, they're going to run into a brick wall that nobody's prepared to part with their silver. So this sucking sound has been going on absolutely everywhere for a very long period of time, and not just these two. Not just the COMEX and not just the Shanghai Gold Exchange or the Shanghai Futures Exchange. All of these silver ETFs have been puking up silver for the last 3 or 4 months.
Beyond futures trading, a more important story may be unfolding in the physical market. Large quantities of silver and gold have been leaving major storage systems around the world. Exchange warehouses have reported massive withdrawals far exceeding new deposits. In some recent months, tens of millions of ounces of silver were shipped out while only a fraction was delivered into vaults. Similar patterns have been seen with gold. Analysts tracking global inventory flows believe this steady outflow suggests strong underlying demand from investors, manufacturers, and central banks seeking to secure physical metal rather than paper contracts.
I'll tell you what, I've been doing this now for 25 years, and, I get the numbers from my chartist, Nick Laird, and, he does the best that he can with all the data that he gets, and you have to assume that if it's not 100% correct, it might be 97% correct. He may miss this or miss that, but, in the overall, you can see the trend. U.S. silver imports and exports, which was in my column today, they received 260 tons from Mexico. This is December, and they shipped out 281 tons, and it all went to the UK, of course, the UK being the LBMA. So all that does is prove that all this silver is getting shipped out. That's for December, and of course for January and February, because there's 51 million ounces left of COMEX, and both months. The other big silver that's leaving is from Switzerland. Now, I don't have the numbers in front of me right now, but Switzerland refines a lot of silver, and all I remember about that is that most of their exports were to the LBMA as well, because LBMA is the physical market for everything. If you want to go out and buy 30 million ounces or 13 million ounces like India does quite regularly, you don't go into the COMEX futures market and buy it, okay? Because 20 million ounces, 40,000 COMEX contracts, or 4,000, and of course you did that, silver would be at like $500 an ounce in 5 minutes. So what you do is you go to London, okay, and that's where you get your physical gold and your physical silver, and you can buy whatever quantity you want and lock in a price that doesn't disturb the market. It's as crooked as hell, but that's the way the system works. It only works up until the point where you get to the bottom of the barrel, like they did in the LBMA, and somebody shows up and says, I want 10 million ounces, and they go to turn around and get it from what's in the inventory, and they find out by looking at it and said, I'm sorry, but we don't want to sell. And all of a sudden, boom, goes the price. And panic sets in, and airplanes leave the COMEX, twice a day with, 3.5 million ounces per plane load to try to fill the gap. So, they're hand to mouth right now, and it's only a matter of time before we're going to see them actually run out of this stuff. And I think if China really wants to, they could really stick it not only to the U.S. but the rest of the West by restricting silver exports. They're the largest refiner of silver in the world, or the second largest producer of silver in the world. And their inventory levels at the Shanghai Gold Exchange and Shanghai Futures Exchange are the lowest they've been since 11 years. I mean, there's nothing there. There's like 9 or 10 million ounces or 20 million ounces total. There's just nothing, okay? And they could just pipe up and say, look, I'll tell you what, because of they could mention the fact that, the structural deficit in silver, that we've decided to restrict exports to 10% of what we're exporting now, and then the fox would really be amongst the chickens. And I don't care how much paper they throw at the silver price on the COMEX, we would see a silver price in the 3-digit category that would just shock everyone.
The decline in available metal is not limited to Western exchanges. Asian trading hubs have also reported shrinking inventories. Storage levels associated with major Asian bullion exchanges have fallen to levels not seen in nearly a decade. These markets play a critical role in global supply chains, especially as industrial demand for silver continues to grow due to electronics, solar technology, and advanced manufacturing. When multiple trading centers simultaneously report falling stockpiles, it raises an important question. Is the world approaching a supply imbalance where demand begins to exceed available physical metal?
I'll tell you what, there's a lot of controversy on that, and I'll tell you right now, I don't know 100% for sure. All I know for sure is that various refiners inside China have an export permit for X number of ounces of silver, or they're allowed to export what percentage of their product out of the country. So they have an export license from the government. Okay, and there's 10 or 15 or 20, I don't know how many there are, but there's a finite number of them. There's not very many. So they're allowed to export either a fixed amount of silver or whatever they want to. I'm not sure what the rules are, but what the government grants, it can also withdraw. And the thing is that, as we get deeper and deeper into this silver deficit crisis, I can see the day coming easily when they pick up the phone or send out the emails to these companies, say effective whatever day, you'll only be allowed to export 50% of what you're doing now, or 30% or whatever, because we're just running out of silver. And if you look at their stockpiles on the Shanghai Gold Exchange, I mean, we're at rock bottom right now. There's almost nothing left. So if they wanted to, they could do it, just not out of spite so much as to save their own skins, because they have only a certain finite amount of silver they make, and they've been net exporters for many years. And, they can only keep that up for so long before they run into this rapacious demand for silver.
Some analysts believe the next major move in silver could come from a supply disruption rather than speculation. Countries that produce or refine large amounts of silver could theoretically restrict exports if domestic inventories become too tight. If that happened, global markets would suddenly compete for a much smaller supply of metal. In such a scenario, futures markets might struggle to control prices because buyers would demand physical delivery. Historically, commodity shortages have led to dramatic price spikes. While no one can predict the exact outcome, tightening inventories suggest the silver market may face a pivotal moment ahead.